except for I can't say visual. Imran, how are you doing, man?
I'm good, man. My favorite time in the month.
Yes, and I'm not going to comment on. It seems like just yesterday we were doing this. We were talking just before here about two things. One, the fancy places that you like to go on vacation, but more importantly, it's a weird market right now, and I think that you always feel like it's weird when you're in it. So I was trying to think: do I always feel like this is weird, or is this legitimately weird? And I feel like it's legitimately weird.
What are you finding most weird about it?
Well, if we're just going to kick it off, man, the juxtaposition between not record low, but 1 year low in implied volatility, realized volatilities at 1 year lows. I think we had the biggest 1 year move in the 1 month Treasury bill ever. I think it was up 1% last week. You got the debt ceiling looming over us. You were just saying a headline came out that surprise, the Tuesday discussions didn't go anywhere. Brent is kind of, the leadership is all concentrated in these AI stocks. We have record call interest, record VIX open interest, and things just don't seem to be making a whole lot of sense. So that's what we're going to try to tackle here today. So I came very organized today. As you know, I sent a list of topics. Usually you and I just kind of wing it. So today we're going to start off with is the good old OPEX pin. This is not a particularly large expiration, right? This is the May monthly options expiration. It is a very sizable expiration in terms of the spider. So I was talking about this in the subscriber note the other day. And if we look at the indices here and we flip over to the spiders, what you will find is that roughly 30% of this position here, this is Gamma by Strike, is going to be wiped out on Friday. And this 412 strike in particular is just a monster. It's the biggest Gamma strike out of the whole S&P complex. And so, as everybody knows, this is widely being talked about now. We're stuck in this range, this 4,100 to 4,150 range. We've been there since really the end of March. And our view is that the pin's going to get kind of pulled here. So, we'll just start off with this. How are you looking at these OPEX kind of pin? Do you think, what is it about this 4,150 area just in general? It's been a real place where the market's just stopped out here. If I turn off the myriad of lines, you can see we've had a hard time getting through this level. So do you think there's something special about this level? And what are you thinking about this OPEX pin?
I mean, look, this resistance is held for a while, like the 4,200 area, but you do keep getting sucked into this concentration of strikes, right? Every time we get an expiry, this area does seem to generally be where systematic selling is being done on that monthly cycle. Yeah. We know the big June strikes are a bit higher, right? The massive 20 billion is like 4,300 or whatever.
Yeah.
But you're going to get fresh selling. You're going to get fresh selling at the end of this week, and that's probably going to be 3% outside. So it's going to be near that 4,250, 4,300 area again, right? So that's going to be your large concentration of gamma for June expiry, so end of June and regular June expiry. If we stay around here, I mean, the way it's trading, yeah, it does feel very pinned, right? Like I didn't realize that the SPY one was such a big one, so I thought it was S&P 4150, but actually the SPY one looks like it's playing a pretty big part of this because it's funny, we do seem to be stuck at more like 4130.
Yeah, it's 4130.
Yeah.
And this is one of the things I realized, that a lot of big traders like yourself that really sling size, you don't want to look at the spiders because you think it's the retail product, but you got to pay attention to that spider market. This is, so here's, this is the Gamma by Strike here. So it's about, call it $500 million at this 4150 if you measure the total maximum position there. And if you just look at the spiders, if you flip back over that, you can see this is closer to $1 billion in notional value, right? So yeah, you can see it's really stuck specifically as 412. I mean, just like glue, right? It's really something else.
Yeah. So you got to back it. Most likely, once we get that out the way, things have at least a week or two to free up a bit, right? I mean, that's kind of what happened last time we spoke, right? We thought it was going to free up. It did free up. It had a little visit down. Didn't last long. You blink and you miss it, and then it just rallies straight back and falls asleep again, right? So. I don't know which way it's going to play out this time. Obviously, we've got the debt ceiling.
Yeah. So here's that April OPEX you're talking about. We had this brief drawdown, right? This was OPEX was right in here, and then chunk down to 405 and then right back, right? That was just vol for sale as soon as we got the opportunity. And then, and to your point, the debt ceiling.
It's a 2-week period there after OPEX into the end of the month. It was able to move, and then it just dies a death again into that week or two into expiry again, right?
Yeah, it's really something else. And I would say we ran some stats last night, and what we found was that in general, when you have a call heavy expiration, the market does tend to come down in the week after. And it doesn't always have to be this violent move, but this is the amount of call gamma expiring versus puts, so calls in orange and puts in blue. So this is what we call a call heavy expiration. And our base case is always looking for downside, if you want to call it correction or just a little mean reversion, just a little bit of a movement, right? Kind of like in April we saw here, right? That kind of fit the bill here, this April OPEX drawdown. And to your point on the debt ceiling, which is interesting, and this kind of moves us onto the next topic here, is that when you look at the fact that, hey, we're going to get this little trigger of possible volatility here with May OPEX, the X date that everyone's talking about, the first possible day of the June debt ceiling, the default, right? The X date is June 1st. And then we feed into the very large June expiration. So here we have the June expiration. As you can see, there's very large positions at this quarterly expiration. If you look back in time here, again, over the past year, the market low was right here. June OPEX was actually funny enough, right at June OPEX, we had the low back in the market there. So you have this point for volatility to be triggered off of the debt ceiling discussions. And then you have these big June positions, which I just think will catalyze the direction of the market. Related to this, I'm getting a lot of stuff out here, Imran, so that we can frame the situation. Related to this, we've been talking about the record. This is VIX call. This is SPX put open interest here. It's near record highs. We have VIX call open interest at record highs, but we have realized volatility at significant lows. So if I scroll down here a little bit, you can see a long-term view of realized volatility here, and this green line is 1 month volatility is quite low. So we have this weird juxtaposition of, hey, market's pinned for OPEX. Hey, volatility's on its knees here, right? Both implied and realized volatility. But we have these record positions sitting out there. So my first question is to you is, when I talk about, hey, I think we could have a lot of volatility heading in this June period, what do you think about the fact that VIX call open interest and S&P put open interest is at record highs? The implication there is people are hedged, right? But you have to, again, compare that to record low, or not record low, but 1 year low, again, implied volatility. How do you contrast those two things when you think about how people are positioned?
Yeah, I mean, you got to look at when the skew and the VVIX are moving, because that's telling you kind of what's going on, right? So in the last few weeks, you've seen an uptick in skew. Well, obviously, you initially had the move in skew on the SVB stuff. Then we mean reverted back down a bit, and then we've gone up again, right? So S&P skew catching a bid is reflective of put buying going on. VIX calls have definitely been getting bought. We've had quite a bit of June call buying. You've had this massive trade go up in September. The 40-60 1 by 3 went up in like 100,000 by 300,000 lots, which is enormous on VIX, right? So that's kind of where the landscape looks on the VIX. So you definitely had that call buying. But I remember it was a similar kind of story in 2011, right? People knew the risk was there on the debt ceiling, and yet the market just couldn't get going until suddenly there was like a release on the on when they got downgraded, when the US got downgraded, and it was like 4% 4 days in a row the S&P did, right? But it was starting to roll over, but it just was doing it so slowly and so orderly, right? That there was just not the reaction you would have thought, and then suddenly something just cracked and it just fell through the floor, right? Did 15% in
so this is that period right here, and we're right at this window, right? Funny enough, right into June expiration. We're right here. I mean, it's a blip on the map now, but to your point, very slow and then all at once, right?
Yeah, exactly. So the skew and the vol being pumped reflects that people know the risk is there, right? They just also know that realized is low. And in terms of very local gamma, the street owns it right now, right? So like right here, right now, if the street's got billions of dollars of these at the money strikes expiring on Friday, they got a lot of gamma in their books, right? Yep. So the at the money vol is going to be low because of that. But 5% lower, they've got no gamma on their books. In fact, they might be short gamma, right? So that's why the skew reflects that. And the skew goes quite steep because people don't need vol here. They need it 5% lower and more, basically.
Right. They're trying to hedge those tails, to your point. And on your point of gamma kind of flipping, we've been really watching the 4,000 level. And the 4,000 level is, there's just massive options positions at that strike. Obviously, the gamma is going to increase if the market slides down there. So if we break this is where I think convexity really kicks in, somewhat to your point about the volatility kicking off, or if we're down 5%, let's say. When you think about the period that this reminds me a little bit of as well, and I mean, you mentioned the fact that there was the downgrade obviously that played in 2011, and I don't know that place, but this is kind of also one of those situations where this is obviously not the COVID pandemic, and so don't suggest that I'm trying to say we're into a global pandemic or anything like that, but this feels like the situation to me where we're all sitting there again, February 2020, going like this is bad, like something looks bad here, something doesn't make sense, I don't like this, but the market kept chugging along, right? And then all of a sudden, right at again Feb OPEX, things broke, right? And to your point, like it just happened all at once, right? All of a sudden, the whole world's like, oh, COVID's here, and everything just kind of broke. And that's obviously a much darker situation I think we have now. These are mostly political games, I guess. But it feels a little bit like that, right? Like everyone's expecting this thing to happen, and it can't be that bearish if RV's at, realized vol at these lows. And then combined with that, now everyone, the word is out on these AI stocks, right? If you look at them, they're leading the charge here in the market. There's a very concentrated leadership here. And so debt ceiling kind of aside, I think that opens the market for a lot of weakness to the downside. But if you switch and sort of say, well, let's look at the upside. Let's say that they sign the paper tomorrow and say, great, unlimited debt ceiling or whatever it may be. The leadership concentration here has been very small. Is that something that you look at or consider, or what's kind of your view of the fact that it's like 10 stocks that are responsible for the entirety of the rally?
The breadth under the market has been disgraceful, been horrible, right? But the reality is, what is going to make people sell these names, right? Like there's passive 401k flows, right? These names are just so big. Those flows are just going into those names, right? They don't care if it's a big part of the index, it just goes in. So, and then you got the buybacks being announced by the likes of Apple. I don't know which of the other big mega cap techs did it as well. Can't remember if Microsoft did, but they're announcing buybacks, and they are the only place where there is still innovation and growth that people can believe in, because they've also got profits, right? The thing is, most of the names in the ARK basket, whilst they've got innovation and growth, they've got no bloody profits. Whereas these mega caps, not only have they got innovation and growth on the back of AI, they've also got the profits to back it up, right? So they are just the dream, but they are like quasi bonds, they're just growth names, they're just cash cows, right? So I can understand why people want to park themselves in there. Now, in terms of valuations, they look quite rich, right? But valuation is never a good way of really thinking about it, right? Because you just don't know.
Values what someone will pay for it.
Yeah, exactly. Whereas I think ARK, I'm wondering, ARK's been held down by the likes of Tesla, right? It's not had a great time post earnings. It's obviously been correcting. But I wonder whether ARK has some opportunity on the upside, because tech seems to be the only game in town at the moment, right? We're looking like it's going to be a recession. We just don't know if it's this quarter, next quarter, or whatever. Okay. Cyclicals are reflecting that. Everyone's already piled all their safe money into defensives like staples, utilities, things like that. But in terms of where the real upside comes, I wonder if it is still coming from tech, right? And if rates have pivoted, if they're done with the hiking cycle, right, and they're going to get forced to bring rates down because the banking crisis literally can't really end until they bring rates down, right? They're in a weird spot, right? But I just wonder, like I was looking at the upside on ARK today, and I was saying to my subscribers that I think these upside calls in ARK on a mid-30s vol don't look ridiculous, right? Because, and I wouldn't necessarily buy them outright with the load of delta right now, but kind of doing like the back ratio type stuff where you sell one call to buy multiple upside calls. and you structure it like that, where you don't pay too much premium, but if you get an explosive move higher, you kick into a load of gamma and a load of vol on ARC, and vol can re-rate 10 points higher up there, because it's not like normal equities where vol has to come down when we rally and it has to go up when we sell off, because ARC is the meme. It's like the meme stock type dynamic as well. So you could definitely see vol spike on the upside if ARC decides to have another go higher.
Yeah.
That's what I'm wondering.
You can't put it past our Kathy Wood to sort of rebalance her whole portfolio into just AI stocks either. So she knows how to market. So then you can get another meme squeeze maybe. But I actually was looking at ARC and thinking kind of a similar thing, that it's an interesting way to play upside, for a lot of those reasons that you outlined there, and it's not, it is off of the all-time lows, but how far that thing is.
Exactly. I mean, the point is, if it goes to 55, that's a massive rally from here.
Huge rally. Yeah, you lose it in the context of how crazy 2020 got for this thing. And kind of the other thing that was funny about, you mentioned the Apple and the concentration leadership. I think, and I might screw this up a little bit, but I think the Apple just priced bonds at yields that were less than the Treasury equivalent, which I thought was hilarious, because people are not as worried that Apple will pay those bills as the U.S. government, I guess. So Apple is the only stock in town, and now all of their debt is better quality than the government, I guess. We're getting kind of deep into questions here, so I want to pick up a couple of them before I forget. First, our good buddy Paul, he says, we talk about the influence of VIX expiration. So my personal feeling is generally that, I mean, there's always this idea of, hey, does VIX expiration fall before or after OPEX? And we've seen some noted effects when the VIX is kind of high heading into expiration. What, if anything, do you think is the effect here? Obviously, Wednesday is VIX expiration, and then that comes after Friday options expiration. So you have a view here on that VIX expiration, if it's a catalyst for any movement here over the next couple of days?
I mean, often, you're seeing the VIX futures collapse into it, right? And they're kind of catching up with VIX spot. So generally, when you see that sort of price action, it tends to look like the dealers are having to sell their VIX futures as whatever the charm is going on in that positioning is making them sell VIX futures, which means it's making them essentially buy S&P, because selling VIX is the same as buying S&P. So that's supporting the S&P. So that's basically, it definitely looks from the price action in VIX that it is supportive to the S&P until expiration. But once expiration goes, then that at least that layer of support is likely gone, right? And then I guess the next layer of support is what happens on Friday with all these spies and all the S&P 4150 area, right? So I think it's just, you've got a few layers of the onion, right, that are supporting the market.
Right.
The first one is the VIX, that's going tomorrow. The next two will be morning of Friday and then close of Friday, right? So that's how it is.
Yeah, and things, seem to get a little shakier the Wednesday before VIX expiration. I mean, historically, we're like, it's going to pin till Friday, and then over the last many expirations, it seems like things start to get a little shaky on the Wednesday before. And I look at it as this same situation where I don't want to try to get too cute with this pinning stuff. After 2 months of pin, the opportunity for vol to spike even just a little bit or pop a little bit and pay off actually some long gamma positions. I think is there. So, I hesitate getting too cute and waiting for the Friday pin specifically to hit. And so to your point is exactly, the layer of the onion is going to start to get peeled back. I think that's just a very nice way to put it. Kind of starting on Wednesday before we head into Friday's expiration. Questions here. So looking at the Q specifically, I mean, it's been the benefit of an incredible kind of tech rally. The outperformance is really, apparent here. And one of the themes I think that seems obvious to me, talking, I guess, back to some of this strength before, is you could see the outperformance of the tech of the Qs, obviously with Apple and Google and the like. But the idea that strength is being bought here more so than dips are getting bought is a theme that seems to have been apparent over this year. And Chase here mentions, hey, don't you want to buy the IWM dip because, do you really want to continue to short this thing? And I think the answer is no. Dips just don't seem to be getting bought in this market. strength continues to get bought and strength continues to get rewarded. And it's a counterintuitive thing, but you want to buy strength, not buy weakness, right? How do you, how do you think about the dispersion here of the performance? And is there sort of a relative value trade looking at IWMs versus, say, Qs?
Yeah, I mean, I'd be wary of shorting NASDAQ. I totally agree with you, right? I saw an interesting chart last week or whenever it was. And if you look back at 1999, when we were seeing the .com bubble forming, right? And the analog was pretty similar to what we've seen in the NASDAQ. And then when the thing decided to break, it did another 80% in the last 6 months of the year, right? So it's kind of like, you know what, fading this thing is dangerous as hell. If you're going to do it, buy some put spreads, close your eyes, decide how much you want to spend, and don't worry about it. But yeah, I just think we can definitely it's very easy to underestimate how frothy these valuations can get when literally the only thing anyone wants to own is going to be something with AI on it, right? It's just it seems there's, you know what I mean? It's like you say, all the strangeness of the market and why the market isn't rolling over is just because the breadth is rolling over, right? It's those AI related type tech stocks that are flying. Everything else looks like shit, right? So we've got to think of it as a very, a separate market almost. And, that is the strongest trend. Would you be fade? You don't fade strong trends like that, right? Not aggressively, right?
Yeah.
If you know what's good for you. Right?
I totally agree with you on that. And the other name that just won't bounce are regional banks. I guess names that won't bounce are these regional banks. To this point of
why would they bounce? Think about it. Like, who the hell in their right mind is going to buy this stuff?
We came off of an environment to 2020 where any drop got bought viciously and any decline just rallied so hard. And my point is that this is not the same market where all drops are getting bought, right? People or all declines are getting bought. People are, to your point, they're going into leadership. AI is what we all want to buy. AI is the thing. So you're buying tech here, and there's just no reason for IWM to bounce, just like there's no reason for the banks to bounce.
Yeah, I mean, on the banks, if they're going to let Jamie Dimon just kind of like pick at the carcass and pick out what he wants, right? And screw all bondholders and shareholders. I mean, this doesn't really incentivize you to buy the banks, right? Like, a lot of these, with the yield curve the way it is, deposits flying out the door. It's hard to see a good reason to buy these things.
Right? It's not a great forward-looking environment for just the banks, and it seems like in general, right? I mean, lending is obviously in the pits right now. To your point, the yield curve is probably not helping their books and all that, and so yeah, why buy those dips when you could just buy artificial intelligence?
Yeah, I mean, as someone's saying, the NASDAQ rally does look stretched, right? If you look at, yields are going up and the NASDAQ going up as well. So yeah, I mean, tactically, maybe you do want to short it, right? But I'm more talking about between now and the end of the year, it could go a hell of a lot higher, right? Don't underestimate what this thing could be capable of. But just in terms of, I mean, if we pull the pin on S&P and we do head lower, then NASDAQ may well go down in sympathy. It's just that in general, it doesn't really serve you to be selling the winners, right? And buying the losers right now, as you've already said.
And I think the other thing is here too, that if we get a big drawdown into OPEX, June OPEX, that is, it's such a good setup here. I think with vol could really spike, and you have these big positions. You could write this sort of fairy tale where the market just careens into June expiration. They use the fact that markets are down and reacting because we don't sign a deal, blah, blah, blah. And at June OPEX, we fire down and we clear out all these puts, right? Record puts get cleared out. All these VIX calls get cleared out. You could have just a heater of a rally, particularly in this sector, into the end of the year. I think if you kind of, it's like a slingshot, right? You could pull that back and kind of let it go. I mean, I don't think there's really too many people that think that the debt ceiling is going to is the catalyst for long-term harm, at least over the next year, to the market, right? It's a short-term. It could just cause short-term volatility and weakness, but I would imagine most of us would bet that a year from now, no one's going to be talking about the debt ceiling again, right?
Yeah, agreed. I think we all know that the debt ceiling's it's going to have to get resolved because there's no other real option for them, right? But it doesn't mean that it's not going to have some shenanigans into it, like we've seen, because we've got precedent for that, right? We've got precedent for the politicians just don't want to get anything agreed to the last minute, and then the market kind of tries to force their hand a little bit, right? So because people want that clarity and that certainty, and like apparently I can't remember who said it, but Jamie Dimon is like, they're having weekly discussions internally, like how to hedge the US default and stuff like that, right? So all these banks are all like looking for ways to protect and hedge that scenario, and so that's why tail risk is catching a massive bid, because there is tail risk there, right? No one really believes it's going to persist. And if that crash comes, everyone knows it's going to mean revert super fast once it all gets done. But that doesn't mean we can't visit it though in the interim, right? Which is what people are scared of.
Yeah, and so I think this kind of ties back to the realized volatility conversation. What I've been trying to kind of describe in our notes here is this idea that, and I had to find the chart, but there was an interesting chart from Goldman that was talking about the straddle price, and the current 0DT straddle is trading around 50 to 60 bips in terms of its price, percentage price of the S&P index. And realized vol has just kind of collapsed, right? And so you end up in this situation where, you get this reflexive volatility selling, and volatility condenses so much that it doesn't take much to force a cover trade. And that cover trade itself can kind of invoke volatility and get the cycle going the other way. And so when you play that low volatility into these larger volatility positions, if we do spike, do you think that these record put positions, record VIX call positions, does that increase the vol of vol, or increase the amount of hedging flow that needs to be outlaid, so to speak, if we start to move lower? In other words, does the market react faster because of these record hedge positions that are on?
Yeah, it can do. And the reason is, it's like, think about it from the dealer's perspective, right? If you're a dealer, and I remember, because I used to do this type of stuff, right? But I remember dealers getting hit in a load of calls or a load of at the money, really short dated stuff, and their book is just long so much gamma. Okay, so they really want the market to move, right? And their theta bill is quite high. Okay, but then at the same time, every man and their dog wants to buy like low delta put options. Okay, so the obvious trade for them to do against all this gamma that they've got and all this big theta bill that they've got is to sell downside. Okay, so then their book carries really well because they've got headline long gamma, they're not paying any theta for it, and they can just trade the market, right? But then the problem is the market's not moving anywhere, so there's nothing to trade, right? But if the market suddenly drops, all the gamma that you've got disappears in a second because it's so local, right? Mm-hmm. And now they find themselves in short territory, and the guys who've bought the puts, they need to hold on to them because they're hedging this like debt ceiling that they don't know when it's going to get resolved, right? So I think it can definitely amplify the bid that is required in vol on the spike when you move away from that, because the dealer's kind of comfort blanket of gamma suddenly goes away, and then it's like, oh shit, we need that was our protection, right? Yeah. So now we got to do something to protect, right?
Right. And to that sort of point, these hedges are on for a reason, and they're likely to be held, as opposed to these speculative. I mean, some of the VIX calls, I think you could argue maybe are speculative, and maybe they closed a little earlier, into sort of the teeth of a spike. But a lot of times, particularly with these quarterly positions, the June positions, they don't get closed until expiration. So the record positions, in my view, can help the market to bounce if they get closed, but they're unlikely to get closed, a lot of them, I think the meat of them, until June options expiration itself. And so that can also help this thing bounce if we can get sort of a resolution rate on OPEX and the like. Then then we could very quickly recover. But to me, it's a recipe, and I wrote about this on Twitter. It's just a recipe. All of this is a real recipe for a pretty nasty slide into June. This is the chart here that shows the S&P straddle price. It's a little tough to see on your screen there, but what you could just see is this is the 0DT straddle, and the price of this just continues to come down as we pin. And so as soon as you get a little bit of movement here, all of a sudden all this has to get repriced. The positions, I think, volatility in general just spikes a little bit because of that. And that can really kind of spark the ball of vol. And then I think headlines will start to matter more. In our note this morning, we were talking about searches for Google Trends of debt ceiling, right? No one's really cared about it up until now. And the closer you get to June, the more the conversations are going to heat up, the more people are going to start paying attention to it, and the like. So I think the debt ceiling meme is really going to pick up, or the narrative is really going to start to pick up. I'm going to hear a lot more about it now.
Yep. Yeah, I agree. I think that is the likely path that we're going to take. Yeah. It's like, but again, it's like, why would you take the other side of that right now? Because it's so asymmetric, right? It's like, you know what I mean? If we get an accident on the debt ceiling, we've seen what that accident looks like.
Yeah.
So, but people are bearish, right? I mean, fund manager survey from Bank of America shows that everyone's a bit pessimistic and bearish. The skew has clearly gone bid. So that's the thing. It's like people are aware of it, but the fear that they're concerned about has not materialized yet. Right?
Yes. And I think, to your point, what the bank crisis did in March is it reinvigorated tail risk hedging, right? You didn't want to really be short those tails. Like, you could be short the tail, and all of 2022 was like the hot thing to do. And then suddenly when the bank crisis hit, it's like, I don't know if I really want to be short these like cheap puts anymore, or there's systemic risk possibly around. So it gives me a reason to hedge, or we've regrossed because we all own Amazon and Apple. And so, we have something to hedge. On your point here, but let's just look at the other side of the coin quickly. The bullish case. We have the breadth is dwindling. It's a few of these leaders. I think you and I both agree that you want to own the breakouts, right? You want to own the names that have strength. And so what is interesting to me is every time we hit this level, our call wall fails to roll higher. And so I've been talking about this, that we hit these highs, right, which is the 4150 to 4200 area, and the call positions dry up. You don't see new positions being added at above strikes, which I think is a recipe for continuing to go higher. And you can visualize that here, where really since November, of last year, this pink line is the call wall. So if call positions build overhead, this wall moves higher, and you can see it's just stuck, right? And the gray line is the S&P 500, and even though the S&P will test that level, we don't see these call positions build overhead. So it is like the S&P continues to stall at this level. Tech continues to do very well. The breadth is dwindling. I just have a hard time seeing the recipe for wanting to own the market, writ large. Yes, we get a bounce if the debt ceiling is signed tomorrow, but I don't know that would be a long-lived rally, right? Because I don't know that what's necessarily holding the market back from, a 5 to 10% move is just the debt ceiling.
Yeah. Yeah, I mean, I think you would get a relief rally because just on the back of skew and vol coming down in the puts, right? That in itself would have a Vanna bid will come to the market, but yeah, that would probably be quite short lived. I don't disagree with that. But it's because you could argue that the market up here isn't really consistent with what the rates market's done, right? So it's kind of, we need to kind of wait and see what happens with rates, right? Like the rates market is pricing in cuts by whenever, September, November, whenever it is. Are we going to get them or not, right? And I think that uncertainty is going to be a bit of a cloud over the market, right? And may well prevent us from rallying too far.
Yeah, I really concur with that. There's all sorts of weird things happening in these yield curves because of the debt ceiling and et cetera. And, the move index is still fairly elevated. I think, the idea of, what's Powell going to do to us has probably come down, quite a bit. We don't hedge the CPI and all these various numbers, like, or the market isn't hedging them like they used to, but there's still a lot of bond volatility and credit volatility, relative to equities, which is, another, odd feature of this market. So we're of this idea that I think if you want to continue to play market rallies, I like the idea of, funding single stock calls, maybe by selling S&P calls, something like that may be interesting. I think you could do a couple of different ways to play upside here for relatively low risk. Do you have any upside plays that you like? I know you mentioned ARK before, but
yeah, I mean, other than ARK, ARK's kind of, for me right now, the main one. I mean, I don't think crypto looks bad either, to be honest. Right.
The problem I have with crypto is it seems like liquidity is really drying up. There was a couple of charts floating around on bid and ask spreads and things like that, and you cover this market quite a bit more than I do. I think this is sort of the own some because I'm scared that it's going to go to 1 million and I'm not going to be in it. But I don't have like a whole lot of conviction in the space. What are you seeing here? I know a lot of people are interested in it.
Yeah, I mean, I released my crypto weekly to my clients today, actually. And the general thing I'm seeing is, we had a little bit of a flush out last week. But crypto is a funny animal, right? Like last year, it was quite correlated to stocks. So correlation between NASDAQ and Bitcoin was like 80% last year, okay? On the back of the fact that rates were going up and, dollar was being strong and things like that. That's completely turned on its head this year. And you've now had the banking crisis and you've had gold, you've had Bitcoin acting much more like gold, right? So it's kind of left equities behind and said, all right, now I'm going to act like gold. It's going to change what it wants to do. Okay. So correlation to gold has been rising. And so, I think there's some signs, positive signs in general, right? The way it's trading. Ethereum and Bitcoin were quite highly correlated and they still are. But in general, in a crypto rally, generally Ethereum outperforms because it's the higher beta asset. It hasn't really been doing that. It's all been led by Bitcoin, and it's showing you that the Bitcoin narrative is changing, right? It's becoming more about like this escape from the financial system and the banking system and stuff, right? So that's quite bullish for Bitcoin itself. And it's also being reflected in the skew curves. So like Bitcoin call premium, Bitcoin skew trades for a call premium, Ethereum skew trades for a put premium, which is quite interesting, right? That they're actually opposite signs, right? And I think that is a theme that's going to start to persist now over coming months. And which is what makes me slightly more bullish Bitcoin, and thinking that upside plays don't look too bad.
That's quite an interesting observation, and it had, who knows, maybe the debt ceiling plays into it picking up as a viable alternative, so to speak. And to your point on gold, I mean, comparing it to the performance of Bitcoin kind of squanders or takes a little bit of luster off this. Gold's been doing very well here. Triple top possibly, but we're at or near all-time highs, which is pretty impressive.
When that breaks, when that level breaks, that triple top level, it is going to scream higher, right?
That's yeah. I'll be down on my bunker celebrating, I guess. I agree with you. I mean, this is the level. A lot of people are watching this, and it's funny because gold is like, well, no one cares, right? That's always been the narrative. Like, it's, Bitcoin is the thing, and it's chugging along. It's doing pretty well.
Look at that, because what was that top?
Little dinosaur sign here to show us that we're dinosaurs. We're looking at the
2013 to 2019, right? The range.
Well, look at that. That's interesting. There, August 2011 was the high, huh?
Yeah. That is,
That's pretty fascinating. I hadn't realized that. Look at the insights we're uncovering here as we we go. All right, so we're approaching our time here. Sagita, good to see you. Two things. One, we got to give our sort of quick summary of what we're looking at here over the next week. You gave your upside plays already for ARK, and then we'll give a quick chance to talk about the downside view. And then we're going to take a break. We're going to talk about the hedge. The hedge is our academy. Imran is the handsome face involved with the hedge. He had a great course that he gave to a lot of banks over there in London where he lives. And we said, can you give that to the people, share it with the people? And so together we produced a really great course. So we're going to take a couple of questions, if you got them, on just sort of tactical trading ideas or concepts. We'll do that in a second. Before we break to that, though, you're long some ARK. I think those are called the Hugh Henrys. I
haven't bought them yet. They're on my radar.
One by a whole bunch. All right, you're thinking about it.
They're on my radar for sure, though.
All right. You got your ARK upside. I like being short S&P kind of calls and trying to get long tech. I do like your ratio call upside, particularly if you get any weakness. If we are given the dream of weakness down into June OPEX, then I think deploying those ratio upside call spreads would be really quite interesting. If you wanted to play the downside, if you're the kind of perma bear fella that some people think you are. How do you play the downside here? Are you playing the downside at all, or are you in kind of just a wait and see kind of mode?
I'm thinking Sep or October put spreads are kind of the easiest way to play the downside, because whether we get the debt ceiling wobble or not, who knows? But you got to think there's much more clarity on the recession by September, October time, right? And so you should see earnings continue to roll over. I mean, that's not being priced, right? Bank earnings estimates are priced to recover into the end of the year, not deteriorate. So if we are, that's not really consistent with the idea that we're going to see a recession, right? So you would have thought that there will be a reason to kind of reprice equities a bit lower coming into the end of Q3. And I think the easiest way to do that, given that vol is a bit more, the term structure is steepened. So vol might look really cheap on the front end, but September, October vol isn't crazy cheap. So just buy outright puts, plus the fact that skew's gone a bit bid, is quite expensive. So when vol has room to come down and skew is quite inflated, then the obvious place to go is put spreads if you're looking for protection. And you can structure some half decent ones. I think I was looking at some SPY last week, some SPY 400 360s to September, and they were giving you like a 6-to-1 type payout, right? So that's not too bad.
That's it's a very good point on skew. That sounds like a hedge conversation. We may pick that up in a second on that one. I like the downside. Actually, I'm along some put flies myself at this time. I do think that in this environment, you kind of want to be long Vega, which is maybe hasn't worked all sort of last year. I think those out of the money puts just never paid, but I actually think they'd pay off pretty well. Now, to your point though, with skew, maybe the put spreads are a little bit of a better idea because you don't want to pay it too much, right? And I'm actually not against the idea of also just being short S&P itself via futures or even spiders here, because I don't have to worry about the vol situation. I don't think there's a ton of risk to the upside here unless the debt ceiling gets signed, in which case I'll just maybe have a stop out here, right? But then I don't have to worry necessarily about the carry cost of anything. So sometimes you just go with the good old fashioned delta there. And again, I just think the scenario here where we're going to unpin with May OPEX, headlines are going to start increasing into June. I don't think anybody thinks that this is just going to be a smooth handshake deal before June. Maybe that'll be the surprise of the whole thing. And we could really get this reflexive feedback into June expiration. And so that's the framework that I'm looking at here. And certainly this 3,800 area, I think is the kind of area that I would start to look for possible downside, but we want to pick up on what big strikes there are as we head into June expiration. So that's sort of how I'm looking at it. I think that if anyone has some questions now on any of the concepts we just outlined, I think Imran's explanation there on skew is quite interesting. Maybe we could pick that up for the hedge. But for anyone who's trying to just either brush up on their options logic or wants to learn a little bit more about term structure and skew and a lot of the concepts that particularly Imran was just talking about here, recommend the course. Sometimes it's helpful also just to start the basics and go up so you make sure you remember all those foundational pieces. But if you got any questions, put them in the chat there and we'll be happy to tackle them. Imran, any topics in particular you want to touch on from an education perspective? Anything you've been seeing out there talked about recently? And
don't know really. What
I got one for you. VIX one day was the talk of the town for like a day.
Yeah.
And then suddenly nobody's really bringing it up anymore.
11, that's quite funny.
It's a challenging, and this is interesting because it talks about the idea of how this is modeled. The way that they did this now is they've changed. So the normal calendar day mechanism, I guess, used in the 30-day or standard VIX is this calendar day expiration model, whereas in the VIX one day, they shifted it to I think minutes, right? And they're only looking at options that expire today and tomorrow. And so what happens is, as you can see that on a daily basis, I think it's easier if we show it on a calendar perspective or on a candle perspective. You can see there's a real pattern here, right? To the way that this trades. In the day, it tends to start at the low and then it moves up to the high. And that's a function of the fact that today's options are all going to zero. And so the weighting mechanism naturally shifts from options that go to zero today to reweighting into tomorrow's options, which have a higher implied volatility. Around Fridays, I haven't really been paying attention to this because I've sort of drifted off a little bit. But what comes up naturally around this conversation, which I think is a good one to talk about, is the weekend effect and volatility and why that may impact, and particularly impact the VIX one day. So as we all often talk about, the VIX tends to spike on Monday and then we'll sell off. It's the Monday effect or the weekend effect or whatever you want to talk about. Do you want to touch on that topic quickly and talk about how it may affect the VIX one day? Let me know if I need to reframe that question.
So I mean, it's just that because you obviously have 3 days over a weekend as opposed to one day, right? It's that the convention that they use in the VIX calculation is not a business day convention, and so you have to basically, you're having a larger decay bill on the Friday to Monday than you otherwise would for the rest of the week. So the only way to reconcile that is to then remark the implied vol higher, so that actually in reality you're kind of decaying the similar amount for every business day. So Monday to Tuesday, Tuesday to Wednesday, Thursday, Friday, etc. Maybe you should have a little bit of more decay over a weekend because more potential headlines can occur over the weekend because you have got more time. And if there's, we do sometimes get like news that comes out over the weekend that causes gaps. But it shouldn't really be worth 3 times every other day. So that's why you tend to see it that vol needs to be remarked back up again because decaying 3 days worth is just too much, basically, right? That's the idea.
Yeah, so there's that natural kind of ebb and flow of volatility. And I think a lot of people who are new to that concept will see the VIX kind of spike on a Monday and think it means maybe something. It doesn't. And, I think the challenge of trying to extract something of value out of this VIX one day calculation has been a little bit tough. And maybe when you get a bunch more data, you could pull something from it. And conceptually, it's interesting, but I have not found myself really looking at it.
I haven't looked at it once.
At all.
I haven't looked at it once. I mean, you can't trade it, and right? You can't trade.
No, you can't trade. You're correct in that you can't trade it. And it's hard to trade off of it, I would say.
All it's doing is giving you a bit of a gauge for what the one-day straddle looks like, right? Is it cheaper than it was a month ago? Just compare.
Kind of. It almost gives you a better impression of what's what's being priced in for tomorrow, I guess, based on some of these the way that it continues higher over the day. So like I said, maybe someone will extract some kind of interesting correlation out of it, but in this far it's not been too terribly interesting. And then you had mentioned in your trade, and I think we'll leave with this because I just think it's interesting. You had mentioned that with skew elevated, and if you're going to start to focus on longer dated options here, obviously that have a bit more vega to them, but because skew is a little bit elevated, those out of the money options may be a little bit more expensive. And so when you're thinking about trading those longer dated options with a little bit of a higher skew, why do you want to spread that as opposed to just buying it outright and maybe buying fewer contracts, but buying, so let's say rather than buying, let's say 5 outrights, I just buy 10 put spreads, right? Why not buy the outright, just buy fewer of them or less notional versus the spreads?
Yeah, I mean, you can do that if you really want to have a load of long vega exposure, and you're going to get even longer if you go down towards those strikes, right? But it's one of those things you kind of, whether you buy a put spread or you buy a put, if the market goes down, you're going to make some money, right? So what I like to do is I like to say, well, what if I'm wrong, right? There's no point only concerning yourself with the scenarios where you're right when you do a trade, right? So I'd rather be like, okay, well, if I'm wrong and we have to wait and the sell-off takes longer than I anticipate, I want my trade to still be here. I don't want it to evaporate in like a month, right? So if I just own the outright downside at a place where downside is elevated, and the fact that there's roll down on the curve because the curve is quite steep, the term structure, then if they get a debt ceiling resolution and vol comes in and skew comes in 1 or 2 months pass by, any puts that I bought have gone to zero, right? Like they're just not going to hold any value, right? Whereas if I buy put spreads, because I'm not long as much Vega, right? Because my carry bill is not as bad, so my theta is much less than if I'm buying outright. Those are the factors that really, mean that if I'm early in my trade, I can reevaluate it and I haven't lost all my premium. I can restructure that trade. I can roll it. I can maybe buy the short put back when it's close to zero. And then I've got an even better, position because I'm now just long the outright put that I didn't have to pay as much for. There's all sorts of stuff that I can do. So I like doing spreads like that because it just gives me some flexibility and it means that if I'm not right in my entry of getting short the market, then I have things that I can do basically, right?
It reduces the cost to carry a little bit.
Yeah, reduces the cost to carry, and like I said, because the curve's gone so steep, the implied vol can roll down that steep curve through time, and that's an extra hit that you have to take, right?
Yeah, very, very good points and great insight there, Imran. So again, if you are looking for a little bit of education, can't recommend this course enough. Imran does a great job, and there's a whole bunch of support, quizzes, a whole bunch of other materials in here to help you through the learning process. Imran, we're probably going to wrap it up there. Let's let people know how they can get a hold of you. You are Mr. @options_insight on Twitter. What else you got going on?
Yeah, I mean, it doesn't look like there's any questions, right, in terms of for the hedge. But, whilst we're still on, guys, I encourage you to ask any if you've got them. Otherwise, I'm options_insight at Twitter. We put lots of daily stuff out, gives you a bit of a teaser into what our content is for our subscribers. We have daily trade idea generation. Don't ask me how I do that. No, but we basically have a volatility dashboard product that allows me to screen cross-asset volatility across all the different asset classes. And then I lean on that to try and generate some smart trading ideas to throw out there. I'm not trading every single idea myself every day, but then out of those trade ideas, I do execute some myself, and I let people know how and when I'm doing that via various trade alerts. And then I actually have a portfolio that I run using those trades that I then show people what that looks like and how that's doing and things like that, which is part of our weekly product, basically.
That's great, and I love the vol dashboard. It's pretty neat to see the kind of the more macro picture, I guess, when I personally focus on the U.S. equity market so much. And as for me, you can reach me at SpotGamma on Twitter. If you want to give anything a shot in terms of our daily notes, our real-time product called Hero, head over to spotgamma.com, hit subscribe now, you get a free 7-day trial, and you can get that daily commentary, get the real-time market analysis if you want to see what the 0DT flow is, or people are buying longer dated options, whatever it may be. It's all in that dashboard. And so, Imran, we are going to leave it there. We will, at a minimum, see you a month from now, and which would be hopefully a more interesting June OPEX. It's been a real sleeper. It's been hard to write daily notes. What happened today? Nothing. So hopefully the June OPEX will have a little more spice to it, huh?
Hopefully. Hope so, man.
All right. Thanks again, Imran.
Well, not if that means a US default, though. Probably best if we avoid that, right?
No default. Yeah. A little bit of a vol pop would be nice. So we can, maybe not as far as a default. I'm with you on that one.
All right,
unless it means my gold goes to 1 million, then I'll. All right, everybody. Thank you all for joining us, and we will see y'all soon.